All right, good afternoon, traders. This is your free video update from Seasonal Swing Trader. And today we're going to take a look at a market that we visited last week, and that is December natural gas, ticker symbol NG/NGZ8. And what we saw yesterday was simply a face-peeling move to the upside. The market had its largest gain in around 14 years, a move of up around 18% due to nat gas report indicating there's a 15-year low in the stockpiles, in addition to colder weather forecasts for the country. Now today we're seeing an equally wicked move to the downside, down 15%. So haven't quite eclipsed yesterday's range, but still some hair-raising price action in nat gas. In fact, since this move started after the gap up last week, market has moved up around $14,000 per contract. Each penny, say from $4.90 to $3.90, is $10,000 a point. So we've moved about $14,000. And if you were short that market, that is what we call a classic face peel scenario. And so we wanted to revisit this trade because we talked about looking to short this market last week. But if you recall, we have to wait for certain things to line up before we just start shorting the market. And the two principal things that we analyze when looking to get into a trade is one, high probability seasonal analysis, and two, high probability chart patterns. We know that going into the rest of the year and even early into next year that we should exhibit some negative price action based on years and years of seasonality data. But we have to be patient and wait for the proper price patterns to occur. Now, with that being said, since we have been so extended to the upside, we have an 18% price bar. Today, we're down 15 to 16%. This may be a market that we just look to step aside from due to its volatility. Now, volatility in nat gas is nothing new, but this type of price action is a little out of the ordinary regardless of what market you trade. However, it's not totally going to be removed from my watch list. I don't want to chase the market down just like I wouldn't want to chase the market up. Option premium is high. And what we would like to do is see if this market can retrace back up a little bit higher without taking out Wednesday's highs. So in an ideal, perfect world scenario is we see the price retrace back up without taking this high, giving us some new entry points to take a shot at a next leg lower. There are a couple ways we can do that. Obviously, you can trade the natural gas futures contract. I think it's safe to say that most people will not or probably should not trade the natural gas futures outright unless you have significant trading capital. There is a mini natural gas contract which is suitable for mid-size accounts. But fortunately, we have the ability to trade a very liquid ETF, and that is UNG. So it's the natural gas fund traded based on the natural gas underlying. It's very liquid. We had about we've had a little over 10 million shares traded today, so we can trade UNG with much less risk. Now we will not have the potential for as much reward due to the leverage nature of the nat gas futures contract, but we can still accomplish what we're trying to do using UNG. So I would start looking at either the December or preferably the Jan expirations. And once we get a confirmed topping pattern, if we get one at all, I would start looking around the 33, 34 strikes to purchase. And depending on your risk tolerance and your capital balance, looking to spread that out with at least, say, a 32 to 31 to 30 strike. As of right now, the 34, 31 puts are trading at $1.80. That's for a $3 max reward potential, only risking $1.80 or $180 per contract. If you want to tighten that up, we could look at a 34.32 too wide for $1.20, giving us max profit potential of $2 at expiration. Both limited risk trades. Personally, I do like selling premium. This market is a little bit dangerous to be selling premium right now, but call option implied in volatility is high. Could allow us to come in and get some decent prices. The high on The high yesterday was 39.87, so I typically would like to start somewhere around the swing high to start shorting. And we can look at the 39s and yield and bring in 40 cents for a 39.41. Spread that out further to a 39.42 to bring in 70 cents. Max risk on the trade is $3 less the premium you receive. We had another explosion to the upside and blew through 42. Your max risk on the trade is $3 minus the 70 cents you would receive, so $270 per contract. That's risk that most of us can afford. If we wanted to take a shot on that gas, again, we're not doing anything today. We're going to wait for this market to confirm a top. Then we can look at some different option strategies to take advantage of that market. So hope it helps. Stay safe, and we'll see you on the next update. Traders, like what you see, want more trade ideas each week? Take a $7 30-day complete member access trial by clicking the link below. You'll have immediate access to analysis and seasonal trade ideas on over 35 commodity and currency futures markets, as well as coverage on all of the major stocks, exchanges, and ETFs in the U.S. marketplace. If you like us, follow us on Twitter and Facebook, like us on YouTube, and we hope to see you on the inside.